So I'm Jonathan Arthurs, and my co-author is Violetta Gerasymenko. Our paper is called New Insights into Venture Capitalist Activity. Once a VC invests in a new venture, do they make decisions about that venture and about how that venture is run based on their forecasts ahead of time, or do they actually go into the venture, learn it thoroughly, and then try to develop it to its highest and best use? What we found in the research was that VCs actually do have a forecast, and it could be an intended IPO. It could be a trade sale in the future. What we also found is that if a VC decided that this company could go to an IPO, an initial public offering, in a short period of time, they were very rapid to replace the CEO and get a professional manager onto that venture. If it was going to take a long time to get it to the forecasted exit, the VCs didn't make a change in the personnel. They were much more happy to keep the founder involved in the organization and continue to develop it. And so that was an interesting finding in the research. The VCs also made different decisions based on their forecast, whether it was a near exit that was coming up or whether it was a far exit, and also depending on whether that was going to be a trade sale or an IPO exit. It was really kind of an interesting way to look at what do VCs do once they invest, and do those choices, are they driven by the needs of the venture or by their own anticipated forecasts? And that's really the sum total of the paper that we found. And the founder needs to make a decision if they're going to get venture capital involved in their venture, they need to know that there's going to be someone else who's going to have some decision power, decision-making authority over their venture. And so if they have a problem with, perhaps they have too much psychological ownership, that this is my baby that no one else can touch, then they need to be aware of that the VC is actually going to become involved. And they might have an agenda, and it may become enacted at some point in time where it no longer involves that founder. And so founders need to be aware of that as they decide whether they want to go with venture capital and how much they want to take from venture capital and so forth. What motivated the research was I met Violetta in 2006 at the Babson conference. I sat next to her, we started eating lunch. I asked her about her research. She says she does VC research. I said, I'm kind of wondering if VCs are good guys or bad guys. And I told her I felt like VCs make decisions a lot of times that are strictly in their own interests. We started talking further, and she said, I have a great data set, we can test this answer. And so it kind of led to our research project. So Violetta was actually working on her dissertation at the time, and she was going to venture capital organizations, and she was working for a VC organization, and she was asking VCs to talk about their portfolio of firms that they've invested in, and then the activities that they've engaged in with each of the firms in their portfolio. We started working on a paper, and next year we submitted a fresh paper on the subject to Babson, and then from there we got great feedback from people in the field and wrote up a paper and sent it to JBV. It was a long, extensive process, but very satisfying in the end. So what we found in the research is that VCs make a forecast about the outcome of this venture. And that forecast could be, I think this will go to an IPO. This will be a very short-term IPO. I can get it to go to IPO in a very short amount of time, or this might be a longer-term IPO. I think it's going to go to IPO, but it's going to take a little bit longer time. Or this could become a trade sale, meaning that we find another company to whom this venture could be sold. And there could be a short-term trade sale or a longer-term trade sale. So we found that this dynamic is present in the VC's mind. The key insight is that VCs make decisions about some of the ways that they engage with the organization. If they decide that this could be an IPO company, but it could go in a very short amount of time, they look to replace the founder immediately. They look to basically professionalize the firm and bring in somebody else who's not an entrepreneur, somebody with a lot more experience running companies. And so they tend to turn over the founders in a short period of time. Now, if it's a longer term play and it's going to IPO, they'll keep the founder there to develop the company. This is the founder's technology, and they're much more involved. If the firm is going to trade sale, their decisions can be quite a bit different, and they're not going to necessarily be the same. So basically what we found out is that VCs make decisions about what happens in an organization based on their forecasts, and it's not always based on what you would think that the venture needs to get to the next step. If you're a founder and you've come up with a venture idea and you've developed the technology and you've gotten this venture going, and now you need some capital. You need to think hard about whether you want someone who's going to be very intrusive into the business being an investor, because once VC invests, they're going to have a major impact on what happens in terms of how much capital flows in, who does what, who has oversight over the firm and the guidance and direction, and oftentimes about the exit. What's the exit that's going to occur? And so if you're the kind of founder that wants to control your baby, then maybe you should look for angel investing that you might have a lot more control over rather than going for the VC route.